rebound in China, the rebound in Korea. So yes, maybe let's say India-US deal could alleviate some of the pressures on the Indian equity market, and you may see a bounce on the announcement of one. But it may not necessarily be redemption for the underperformance that we have seen so far for MSCI India. You need a little bit more bottom-up push, I expect, for this underperformance to close.
Sanjay, hi. Great to have you with us this morning. So much going on. We are running into yet another earnings season. And, if we just go away from the global noise and what the US administration is doing or isn't doing, at the end of it, it boils down to earnings, right? And that is where we are yet to see any sort of a meaningful pickup. Now, are we at an inflection point where that changes because of all the policy stimulus, GST cuts, RBI, etc.?
Good morning, Surabhi. I think we could be at one, and this was one of the themes at our conference that we recently concluded. And I was worried that participation might be soft given that markets been flat, but there was a big vote of confidence. A lot of people showed up, and one of the things that everybody was trying to explore was this: there has been a lot of, let's say, stimulus affected through the tax cuts, the GST rationalization, of course, combined with the rate cuts that you've seen, and this could lead to a revival of consumer expectations. Now, this is not likely to show up in numbers for the September quarter because the cuts happened very late, of course. But I think the results season this time around, there will be a lot of focus on how companies talk about the upcoming quarters. Have they seen a change in inflection? Have they seen a change in consumer trends? And therefore, there is this possibility that you get a little bit of momentum in earnings, especially given that we've already cut our numbers quite a bit in the last few months.
All right. Hi, Sanjay. Good to see you. And as always, what about the FI behavior? What are they thinking with regard to India? We used to be a darling till, 12 to 18 months ago. And that selling has been relentless. Though, thanking our stars in the last week or so, that cooled off a little bit. But they continue to remain net sellers. Their holding in the Indian markets is at a multi-year low. And in the FNO market as well, they're net short. Do you think that there are signs that gradually at these valuations, with the kind of measures taken both on the fisc as well as on the monetary side, and the hope that earnings come back, the FIs gradually start piling on the Indian stocks yet again? Or do you think that still has some time?
We'll see how the plays. These are very difficult things to anticipate in the short term, of course. See, India, everybody agrees, has a lot of potential in the long term or the medium term, right? There's all the known tailwinds of continued urbanization, the manufacturing drive that the government's pushing, urbanization, that's likely, the demographics that everybody agrees to. So those factors sustain, and India therefore remains a place of inquiry for everybody for the long term. I think the challenge, at least in the near term, is the fact, like I was saying earlier, that other markets have delivered much sharper bounces. There's greater clarity on many others, let's say, tech-related sectors, of course. And a lot of investors were not necessarily positioned to participate in those rallies early on. And therefore, you see continued rotation out of India, which had been owned by them for a while, into these newer momentum areas. So until you see that reverse, the relative argument reverse, I'm not sure you're going to see too much of FI flow come back just because the market's underperformed.
So Sanjay, what you're saying is it has to be someone else's loss for the market here to do well. So let me explain. I don't mean it literally. Basically, from what I understand, what you're saying is money is going into themes like artificial intelligence, infra build out there, etc. You don't have very much here to as plays on that. So at some point that reverses, and then people start to sort of look at other areas. Right now, it's all concentrated in one big theme globally. Is that what you're saying?
There's not just one. There's, let's say, the stimulus in China, the rebound in Korea that you saw as well. So tech being just an example that I was using, Prashant. So I'd argue that, look, equity investing is a relative game. And if you have greater confidence of earnings momentum, and let me just highlight this one point. EPS expectations for the S&P in the near term are actually being upgraded. Right now, you can debate why it is happening. It's only tech-driven, or that you would cut them too much after the Liberation Day tariffs, etc. But nevertheless, for equity investors, you're seeing upgrades in the S&P EPS number. How sustainable they are, we can all debate. But in India, we have not seen that earnings momentum as well. So you need to start to, let's say, catch up on those trends, deliver some bottom-up momentum before you can claim some interest from foreign investors.
Sanjay, on that point, I know it's a little out of subject for us sitting here talking about India stocks and India earnings, but since you have that worldview as well and you met so many people at the conference, there is some chatter that's starting about whether global markets, starting with the US itself, is now, in the build-up to a bubble stage. And I read some stuff over the weekend as well. I mean, private credit in Europe has gone all over the place, and there was a bankruptcy over the weekend, and then there was some, murmur of, we all remember how we got to that point of 2008, right? So I'm not saying this is anything similar, but is that a concern? Because then all bets are off, right? I mean, if we are at that point in global markets where perhaps there's a bigger correction coming. I mean, look at what's happening to gold. It's just going up, and central banks are buying, not just speculators. So just your views.
Well, this can be a very long discussion, of course, Surabhi. But look, Archie suggested that the markets or economies seem to be in some sort of bubble stage. Whether we are mid-cycle or late cycle is extremely difficult to pinpoint. But there are excesses clearly. The only saving grace, I'd argue, is that corporate balance sheets nowhere seem to be very leveraged. So unlike, let's say, 2008, as you referred, there doesn't seem to be a leverage problem in the corporate sector, but possibly a leverage problem in the government sector, where governments have borrowed, debt to GDP has gone up materially. And consequences of those might actually filter through into economies. But we don't expect, at least personally, I wouldn't expect much of a corporate sector blow up because there isn't much leverage in the system.
Yeah, that's good to hear and good to have that reminder so we don't have to get too worried. So which brings us back down to, how people should look at their India portfolio. I mean, and there's this other debate, capex versus consumption, saying now, do you need to unload a bit on capex and move some of that money to some part of consumer? And where are you on that? And within consumer, where should the focus be? Because it's a very large basket overall, consumption.
In the near term, I think the answer is very, very evident, Sulpi, that the stimulus that the government has affected, I mean, we should hesitate in calling it a stimulus. It's a shift in policy preference, if you will, because the fiscal deficit will remain at, I would expect, 4.4. You're just taking, some money I expect from capex-related spends to the tax cuts that have gone through. And combined with the rate cuts, there is enough of a momentum for mid-income households to reconsider their purchasing decisions, right? There is that consumer stimulus. So looking at more consumer-oriented stocks in the near term makes a lot of sense. Now, the challenge, of course, investors face is many of the stocks have already gone up. So the question is, where is it not priced? Where are further surprises likely? And we would argue that where there is elasticity to the price cuts that have come through is where we would continue to look at. So maybe some of the auto-related names make sense. The discretionary, obviously, you'll have greater elasticity to price cuts than staples. So those are the sectors where, I would agree with the consumer over capex in the near term, but more discretionary than staples.
Yeah, and that's been your call, Sanjay, for earlier this year as well, I recall. And that call actually has gone very well because staples have still not picked up. The growth is extremely anemic. And with this GST 2.0 boost, discretionary could get a further boost. That said, how are you feeling about the markets? You're sounding a little bit somber still, and earnings have not yet picked up. If earnings don't pick up to the extent possible, a lot of newbies in the market, they are frustrated last 12 to 15 months. In fact, the index itself is lower. Do you think we could brace for a couple of years or maybe single-digit returns itself on the index, and that would be a good case outcome?
I would lean towards that. Now, the issue, of course, is that the higher multiple that you buy it, and this chart is clear over the last 20 years, the higher the entry multiple, the lower the future returns. Right? These are very self-evident, I think, pronouncements. And so if you do buy equity assets at current valuations, your expectation of future returns cannot be in the double digits on the index ETF. If you are able to, let's say, buy stocks and some of them deliver returns, that's separate. But on an index ETF, you should not expect very high returns if you're buying at current multiples. On your first question, of course, Nigel, is on what we think of the markets. Look, it looks like you could see a little bit of a bounce because, like I said, expectations have been right-sized, earnings have been cut. Valuations for the Nifty are at 10% on discount to the S&P 500. And India tends to track the S&P multiples reasonably well. Plus, of course, we have this hope that December's March quarters turn out better for the consumer-facing stocks in the economy. So I wouldn't get too negative on the index itself. In fact, I would argue that there's probability of a little bit of a bounce in the near term.
Yeah, no, absolutely. I'll just quickly run you through what's happening. Just take a quick look at some other stuff which is happening, right? 10 points, by the way, on the Nifty. So 24,885 is where we are at. BSC is picking up a little bit. It's up about 3.5%. And stocks at about 2165 right now. Of course, lost a fair bit from the highs of about 3,017 or so. Basically lost $1,000 clean from the highs in August to where the lows were recently. The one bit of news flow, and we'll have to, see. There's actually, the thing is, there is no news flow, and that's the reason why the stock is going up. The news flow, which was that consultation paper on, futures and options segment, and whether weekly options should be, just discussing whether weekly options should be done away with, and the focus should be on longer tenure derivatives, etc. Now, the SEBI member who's kind of spearheading this is retiring this week, end of this week, and will we see something over the course of the next 5 days, or will it be a new person who sort of starts to come in and kicks this off, in a fresh way, fresh look, and does that provide some amount of relief to that category of weekly options product? I think that is what remains to be seen. I'm not sure this is related. The move is related to that, but I thought it's interesting to just highlight what's happening there.
Just one more point,
yeah.
Prashant, on BSC, the stock, I was just reading a sales note that came out. Its stock is trading at around 38 times its forward multiple. And that's a 15% discount to the last 2 or 3 year average. Yeah. The stock has corrected, as you said, 30% in the last 4 months. And another note is suggesting that the impact of this weekly expiry swap hasn't been as much as what they feared earlier. So, looks like a whole host of factors that are coming together, and that could be one of the reasons why the stock is up. Just one more stock, Hemisphere, we were talking about it. Hemisphere Properties, the stock is now down, I think, close to around 15%. On the exchanges, they've noted that they put out, a property in Pune on e-auction, and the bids didn't come, on expected lines. So that's the reason why that one is down close to around 18% or thereabouts. It was put up for auction between the 1st and the 3rd, and no bids came in. So that's why that stock is down close to 17 to 8%, probably the reason.
The other big stock, not big stock, but the big M&A which we reported on last week was Tata Capital. Now, Samman ended kind of flattish, slightly lower, 1%, 1.5% by close on Friday. It's down 3%. It's got the largest volumes on the NSE right now. Number one volume traded, loser. It's a 3% cut, not very large, but 150, just under 160 is where it is at. Some of these are just pure reversal moves. AG's logistics went up sharply on Friday, so it's giving back a little bit. I can spot Premier Explosives, which is up very, very sharply right now, which is up about 6% or so. So lots of new things into the mix as we track markets. E2E Networks is up another 5%. Maybe we should look at NetWeb as well. NetWeb, I think, had a blowout September, and it's, I think, taking it a little easy this morning, down about 0.5% or so. Let's just focus on Avenue Supermarts, which is D-Mart. And let's go across to Mangalam to run us through what the quarterly update looked like. Mangalam, over to you. Morning.
Good morning. So, D-Mart, is lower in today's trading session. There were no great shakes in the quarterly update. Nothing really to write home about on both the upside or the downside. Why do I say that? Because, the standalone revenue grew at around 15.5%, which is pretty much in line with their 3-year average of 15.8% growth. So, no great shakes on either the upside or the downside. They've added 8 new stores in this quarter, which is basically, the first half of this year. Around 17 stores is what they've added. The company has been looking to accelerate their store addition, so that's something we'll be watching out for going forward. Year on year, the store addition has been 14.5%. So you would say 15.4% revenue growth, store addition of 14.5%. Implied same-store sales growth is on the lower side, closer to around that 1% mark. The reason why the stock is sharply lower, despite having corrected from levels of around 4,700, 4,800 earlier, is because the street believes that going forward, the reported revenue would be a lot lower than historical rates because of the impact of GST cuts. So now something that was charged at around 18% or 12% coming down to 5% would imply that the MRP goes down, and as a result of which the D-Mart selling price goes down, and that would reflect in their revenue. So volume growth will be very important to track. Performance of D-Mart Ready is something that the street will be tracking, as well as quick commerce speaks about competition easing out. And finally, the store addition outlook, because that's something that everyone's pinning their hopes on when it comes to growth for D-Mart coming in, especially from Uttar Pradesh, where they recently opened a store.
Okay. All right, so Avenue Supermart under pressure today after that Q2 update coming through. Mangalam, thanks very much for that. But for the timing, let's move on. And it's IPO Street, which is buzzing and as alive as ever. Today, it's all going to be about a large issue that's coming to the market. Tata Capital's 15,000 crore rupee IPO is opening out. It is the largest issue of the calendar year so far. And we have the main gentleman with us, Rajiv Sabharwal, Managing Director and Chief Executive Officer of the company, joining in. Mr. Sabharwal, thanks so much for joining in. And, it's a pretty momentous time. Every time a Tata Group company comes to the public markets, obviously there's a lot of excitement. Now, people really want to understand the business and what your vision is going forward. Because if I look at the FY25 performance, then the overall growth was, absolutely, it was a blitzkrieg over there. I think 40% growth, right, on the book. However, there are those who also point out that your yield on advances and margins have been lower than your, peer set NBFCs. So, is this going to continue, that you will focus on that kind of growth, even if margins, say, remain slightly lower than the average? Or is there going to be a change once you become a publicly listed entity?
So, if you look at our overall growth, we had the impact of the merger of Tata Motor Finance last year in FY25. Though we got the merger approval in May of this year, the merger dates back to 1st April 2024. So if you exclude Tata Motor Finance book, we've been growing at 25% plus over the last few years. We believe India provides that opportunity of growing at that space. And it also happens because we are present in all segments. Retail and SME, which form about 88% of our book, itself grows at about 17 to 18% in the Indian credit market. And besides this, we are also present in the corporate space. So being present helps us. In terms of margins, I think our margins should be looked at with perspective to our credit costs. Our credit costs have been the least in the industry. If I take away the merger of Tata Motor Finance, Tata Capital has always had credit costs of below 1%. As far as the future is concerned, I think we've always looked at how we can add new products and grow them, which provide better margins. If you look at our housing business, affordable housing is the fastest growing segment there. It is growing at over 30% over the last few years. And we are among the top 2 or 3 companies in that space. We always look at that.
On affordable housing, Rajiv, good morning. Most NBFCs we speak to, they kind of lament the fact that affordable housing is a segment. When there's not enough stock on the affordable category to fund. That's the feedback that we have gotten occasionally. Is this on Tata? I mean, is there a lot of group? I mean, are you lending to, say, Tata Housing and developments, etc. there?
No, that is a very small portion.
Okay.
That's not the big thing. But, when we talk about, affordable housing and the stock being limited, we are actually talking about the organized developers. But if you purely look at affordable housing, it's largely a self-construction market. 80% of what we fund there is actually self-construction. When we go deeper into the markets, that's where we realize the real India is throbbing and alive, and there is a lot of activity.
So how does the loan book break up? I mean, so retail is about 60%, right? And that includes housing is within that. So just give us the broad areas where...
So, Brian, if you look at our book, about 63% is retail. Roughly half of that would be housing, and half of that would be other consumer loans. About 25 to 26% is SME, and the balance 11 to 12% is corporate.
Just to go back to the point on margins and yields, I guess it's also a function of, because all put together, I think over 70% of your book is secured, right? I mean,
actually speaking, if I talk about retail unsecured, which was in
the big talking point last year,
that is just short of 12% in our total book. So largely our book is secured in nature.
And do you intend to keep it that way? Because for a lender, that's always going to be that question to ask, the trade-off between higher yielding unsecured assets versus secured, slightly lower yielding assets. So do you intend to keep it at 12%?
So our approach is to create a very resilient book, an asset book which should not only do well when times are good, but should do well also when times are not so good. In terms of our mix of retail unsecured, what we have seen in the past few months, that the worst of credit cost is behind us. We will watch it over the next few quarters. And if things go well, we will look at accelerating that growth too.
Consumer
the
segment,
unsecured part of it.
Rajiv, consumer segment is 30% of the loan book, right? Consumer finance. And SME is another 26 odd percent. The GST cuts that happened, it's supposed to show up in a big way. I mean, I've spoken to companies like Bajaj Finance, etc. as well. Yeah. These are the two areas where it's supposed to have an outsized impact. Are you already starting to see some of it?
Absolutely. This is actually, if you look at it, it's a very significant cut. It's not a small tinkering, it's a big cut. And the impact is visible whether you talk about PVs, CVs is still taking some time, but if you talk about two-wheelers, tractors, I think this is clearly visible. I think there are some products where the impact is immediate. There'll be some products where through the raw material, the impact will be seen over the next 3 months or so. So I think we are really expecting Q3 and Q4 to be really bumper quarters for this year.
All right. Hi, Mr. Sabharwal, and thanks a lot for coming down to the studio. A couple of quick questions then. Part of the issue will be a fresh issue. So how does it change your return ratios? If you could give us a sense on that. And also, if I look at some of your peers, whether the commentary that's coming in from Bajaj Finance or even in HDB or even Chola, which is, one of those companies that has been the leader in the last few years. They said, one of the comments that they made was, this year is a year of collections, not of disbursements. That's giving you some sense of the industry. What is your right to win? Because some of those shareholders in the unlisted market bought the stock at a much higher price. So there will constantly be that concern on that front. So return ratios and your right to win.
So if you look at our offering, it's a mix of primary and offer for sale.
Yes.
With the primary offering, our cap ad, which is will go up to over 22%. Our leverage will come down to below 5%. As far as returns are concerned, I think you need to give the organization another 1.5 to 2 years to fully utilize this money so that the return ratios keep getting better. I feel when you talk about the credit quality and such issues, we've been pretty quick on responding whenever there were challenges. In fact, when we saw challenges in certain segments, we became tighter and more conservative. And that was reflected in terms of our growth in those areas also. As I mentioned just some time back, we feel the worst of credit cost is behind us.
Okay.
And we should start seeing only better things. The reason also is because the market also has become far more responsible, both on the retail unsecured side. The other side which faced a problem was microfinance, and MFIN brought in a lot of regulations. So those things, I believe, have made the market more stable.
Okay. So, talking about capital support, like Prashant mentioned, because less than half of the issue is a fresh issue, the rest is in OFS. How well capitalized will you be? Will there be the need to look at any further equity capital support from the parent? Just a bit on the capital structure going forward after the IPO.
We've always had tremendous support
from your parent.
Absolutely. Both our Tata Sons chairman, Mr. Chandrasekharan, and Saurabh have been extremely supportive. As far as this money which we are raising at this point of time is concerned, this should allow us to grow along with our own profits for the next 2.5 to 3 years. And post that, we may be in the market again to raise money.
Okay. 2.5, 3 years. Okay. And any sense of, you're saying that, so obviously you see a lot of growth in the future. But what would be the capital requirement if the growth expectations are met? And you say you've been growing at about 25% anyway, ex of the Tata Motors Finance business.
If you look at it, the market right now, we are raising about 6,846 crores.
Correct.
Plus, there will be internal accruals through profits coming in. I think a combination of this, we do believe, will be sufficient for us to give us a growth rate, which should last us for the next 2.5 years. We can't talk about the future growth rates, but if you look at the past few years, we've been growing at 25% plus.
Rajiv, on a lighter note, not a lighter, it's a serious question, but maybe prefacing with a lighter comment. By the way, missed you at the Banking Financial Services Summit this year. I had you on the NBFC panel, I think it was last year, the year before that. This year we had an interesting gathering, and I was just saying that banks are like airlines, right? I mean, they carry heavy loads, regulated strictly on schedule, etc. Fintechs are like ride-sharing platforms, sleek, sophisticated, kind of sexy. I mean, if you go there. And NBFCs are like railways. I mean, they take a load of people and go where others don't want to go. So there'll always be NBFCs which do well through cycles, and we've had a few of them. But in terms of the ability of what banks can do now and what NBFCs are able to do, allowed to do, you just saw, right? I mean, RBI's measures. Nothing on the monetary policy side, but lots of regulations, really unshackling banks and allowing them to really do a lot more. Is that going to be an issue? Not an issue, but banks are big competitor in that sense. In many areas which so far were largely sort of served by NBFCs.
So that's always been true, Prashant. In the Indian market, competition is given. Whenever you find a segment which is profitable, there'll be 10 more companies wanting to jump into that. Luckily for us, this is a more regulated market, and things are more sane here. If you look at the whole set of banks, you will realize that there are top banks and then there are another set of banks. Even if you take the top private banks and when you look at us in size, we'll be in the top 6 or 7. Similarly, there are NBFCs which are at the top, and there are other NBFCs. So if you talk about us, what we are seeing is because of the trust which we enjoy, the credit rating which we enjoy, we do get the benefit of one of the lowest cost of funds in the market. And the ability to then target the best customers is possible for us, which again leads to that whole virtuous cycle of getting a lower credit cost, and then again getting a lower cost of funds. So I feel this market will remain competitive. We will all have to figure out our own niches to play in. And the good part, what we are seeing in India is it's huge. We continue to expand and we continue to see opportunities. So that's the plus point, and the growth is visible in all markets.
Which brings me back to the same point. I have to ask you this. On growth, I don't think the market has any issue. On the pedigree, absolutely no issue whatsoever. The only bugbear has been margins. But you've said that if things remain stable, you may want to build on the unsecured book as well. So your margins have been between 5.2, 5.3% largely. Is there an aspiration to start going towards 6, maybe 7, and inching towards high single digits at some point?
So if you look at NIM plus other income, we are just above 6, around 6.1%. And clearly, in terms of what returns come in, one benefit does happen from margins, as I mentioned, that we are adding more of high NIM products, which should give us better things. The other benefit which accrues to entities like us is cost to assets. Because of the significant benefit which we are seeing on account of digital and now Gen AI, we do believe that there will be a step change in cost to average assets over the next few years. Just to give you a sense, our housing company in March 23 had a cost to income of 40%. In the quarter which just went by, it was 31%. Because of the huge impact of digitization and our investment there and Gen AI, you will start seeing a big plus also coming in from cost to average assets.
Okay.
Well, Rajiv, we'll leave it there. Thank you very much. I hope this is the first of many discussions as you start your listed journey. Good luck for the IPO.
Thank you so much.
Thank you very much. Well, I think we're going to take a quick commercial break here. We'll come back in just a bit from now and chat with the management of PNB. It's financials and focus second quarter business update from PNB. So chat coming up with Mr. Ashok Chandra in just a bit.
Welcome back. You're tuned in to Corporate Radar. Well, the next guest on our show is Ashok Chandra, the MD and CEO at PNB, who joins us on the show. Hi, Mr. Chandra. Good morning, and thanks a lot for joining in. Just coming to you in a bit. First, we'll just lay out the big focal points that we're looking at. Loan book growth to outpace guidance. Is that a possibility? The corporate loan book is showing some signs of revival, and also support from Treasury book to be visible in Q2 or not. That's something that we'll try to gauge. Mr. Chandra, thanks a lot for joining in, sir. Pretty impressive update is what you're put out there. So let's revise a couple of numbers. What's the guidance with regard to the loan book growth? Point number one. And if you could tell us, it's going to be led by retail. And are you seeing signs of green shoots in the corporate book as well? Give us an outlook on that front.
Yeah, good morning. See, I will not be able to talk about the Q2 numbers, whatever we have disclosed on the SEBI. I think it is already known. Let us wait for the final audit to come, and then we will disclose all those numbers. But yes, the guidance which we have given in this financial year, that is credit guidance, we have given 11 to 12%. I think definitely for the full year, I think we will be sticking to that guidance, and there will be some good momentum will happen. Deposit guidance, which we have given 9 to 10%, and already we have shown a good growth in the deposit, and we have already indicated what is the deposit growth that this quarter it has happened YOY, and it is more than 10.5%. I think the full year, the guidance which we have given 9 to 10%, definitely we are going to achieve those guidance. So I'm very much confident that the Q1 and Q2 put together and the full year, whatever guidance for the full financial year which we have given in the beginning of this financial year, I think definitely we will be going to achieve those numbers.
Mr. Chandra, we just had Tata Capital Management with us, morning Prashant here, and they're saying bumper third quarter, fourth quarter on the back of this GST cuts, especially consumer finance segments, SMEs, etc. Of course, I mean, for you, the book is much, much larger, but could do you echo that?
Yeah, I fully agree with that. And in fact, if you remember my discussion on the GST implementation on 22nd also, and when the GST rate cut had happened, on that day also I had interacted with all of you. And I had indicated that it is a landmark movement that has happened in the GST space, the simplification and the rate cut which has happened. I think that is going to bring a lot of momentum in the credit portfolio in the various segments. And see, this is not the short-term effect. We need to look for the long-term impact of this GST rate cut. And I'm very bullish about the credit offtake, which is going to happen in the retail, agri, and MSME, because the GST rate cut has impacted all those segments. And second important factor is that many of the items which a household daily uses, the rate has been made zero now. So definitely the purchasing power capacity of the individual is also going to increase. And this impact has been to every citizen in the country now. So definitely that impact is going to happen. And we are seeing those impact in the retail, MSME and agri, all these sectors put together. In the 10-15 days span itself, good momentum has happened. And going forward, I think definitely there will be good uptick will happen in this entire portfolio.
Mr. Chandra, great to have you with us on the show this morning, sir. So retail, agri and MSME, I mean, these have been growing very well in the past as well. Your first quarter performance was very good across these segments. My question is now on corporate, especially in light of what the RBI did in the last policy, right? I mean, pretty historic steps. They have made it easier to lend to large corporates, removed some of those earlier 2016 restrictions. They have allowed banks to get into M&A financing in a bigger way as well. So what is your sense? Do you see any signs of pickup in corporate credit? And my question is really that the RBI is enabling banks to lend more to corporates. But there has to be on-ground demand. Just, loosening the framework won't help. Your thoughts on this?
I think RBI has done whatever is required to be done. And for the last 7-8 months, a lot of facility it has been given to the banks to go for the project funding and the infra funding and all. A lot of things have happened. And if I can talk about our bank itself, I had indicated last time also that we had a pool of 1,38,000 crore sanctioned book for the corporate. And this has further gone up now in this Q1 and Q2 put together. I'm very confident that the sanctions which has happened in the last year and this year put together, the size is very, very high. And my request to the corporates now, they should come forward and they should avail the facility. I think it is not, there is a dearth of proposals. Proposals are there. And that is the reason we have the good sanction book. Only thing is that the disbursements are taking time. To some extent, see, a lot of project funding we have done, project financing we have done. And there, you know that it takes 1 to 2 years to take the full disbursement. That is one of the reasons why you are not able to see the impact immediately now. I think definitely in a span of 1 to 1.5 years, you will see the good impact happening on the project funding. And PNB is one of the largest banks in the country.
Yeah,
and
so absolutely. I mean, your words are very encouraging. So overall, you are expecting your book to grow 11-12%. If I were to ask for some sort of a reference guidance for the corporate book particularly, the growth this year would be what? I mean, mid-single digits. Can it touch double digits? If not this year, at least as we get into next year?
We are very hopeful, and the book size which we have, which is the sanctions pipeline and the proposals in hand, all put together, I am very bullish that definitely in the end of the financial year, definitely we should be in a position to touch double-digit growth in the corporate loan book also. I am very bullish about it.
All right, Mr. Chandra, a few other factors. You know, when you join us, post your numbers again, we'll push you for some more numbers. But a few factors, PNB Housing Finance, that appointment, the new MD at the helm. When do we expect that, sir? The names are submitted, I believe. But when do we hear about that big announcement?
See, PNB Housing Finance Board they and the NRC, they are already running the process. I think you are all aware that advertisement was there and they had sought for the names and final selections are going on now. I think we are expecting that maybe by end of this month, I think definitely the board and the NRC should come out with the name now.
Okay, all right. So that's out of the way. We'll wait by the end of this month. So we've got a timeline at least. The other one is in terms of consolidation of PSU banks. Have you heard any directive that's coming from the center? Because that buzz again has come about. Even today I was reading a couple of papers and we as well have been reporting it, that there could possibly be some kind of more consolidation in the PSU banking names. You've heard something?
I think let us wait and see what it comes out. As far as I'm concerned, I'm not fully aware about this news item and this consolidation piece. So let us wait and see how the government proposes and the DFS and the RBI, how it comes out.
All right, we'll wait by for that. And finally, the Canara HSBC Life Insurance, you know, out there, that IPO, I think the date has been announced. I think you all have close to, PNB has around 23% stake in that entity. So you'll be offloading some stake. If you would give us rough clarity on what is the money you'll be getting from this and what is the quantum you'll be selling in the IPO?
Yeah, we have 23% holding in Canara HSBC Life and 10% we are going to dilute in that and the price band and the valuation all put together. I'm expecting in the range of around 900 crore we should get out of this, the selling now.
Okay. All right, Mr. Chandra, always a pleasure, sir, speaking to you. Wishing you all the best. You're sounding very optimistic about the core business. And you've given us some guidance with regard to PNB Housing Finance, consolidation, as well as the stake you'll be selling in the next IPO of Canara and HSBC. Wishing you a good day ahead, sir.
Thank you.
And looking forward to speaking to you soon. Well, we have got the markets to look back at. And gradually, you know, we saw an intraday dip. But on the Nifty, that dip has got bought into. And the Nifty Bank is holding its ground. It's gradually moving towards that 100 DMA, while the Nifty has moved towards that 20 DMA mark as well. The Nifty Bank actually has taken out the 100 DMA. So now it's trading above most technical levels. Vinay Rajani joins us on the show. Vinay, what do you do? Take money off the table? Or do you say that this market is looking good for more? You'll want to trail your stop loss now on the upside.
Yeah, good morning and thanks for having me on the show. So it looks like that one should continue to do the trading in the on the long side in the sectors which have been doing good. As we have been discussing, the financials and Bank Nifty have been performing well. In fact, Bank Nifty has taken out its previous swing high well. If we see the Nifty is way below that the previous swing high. So definitely the sector rotation is going on. Some sectors are showing great amount of strength. So financials and banking is the space where we can see strength building in and some more gains can be expected from here as well. So yes, overall we are bullish on the stocks and sectors. And definitely Nifty is having a strong resistance at 25,020. It is not showing any momentum. But even if we have the Nifty as a long position, then we would suggest a stop loss at 24,880 in the spot, and we can expect it to go up to 25,020 odd levels in the immediate term. But Bank Nifty definitely looks better than Nifty, and one can trade long in the financial stocks.
Okay, Vinay, morning. What about individual names? What would you focus on?
Yeah, so in the private sector banks, City Union Bank is looking good to us. So around 219 one can go long. 215 should be the trading stop loss. On the upside, we can expect a short-term target at 226. The second pick we'll take from the financials, that is Bajaj Finserv. So after showing some running correction today, Bajaj Finserv has resumed its uptrend. So not only Bajaj Finserv, if you see Poonawalla, Bajaj Finserv, Finance, Shriram Finance, all these stocks from this particular space after RBI policy announcement, they have been doing good. And I think Bajaj Finserv is one of the stock one can look at for the long trade. So around 20,301 can go long. 2000 should be the trading stop loss. On the upside, we can expect a target of 2090.
Okay, all right, Vinay, we'll leave it there. Thank you very much for joining us. Those are individual trades coming through. Well, we're going to focus on Bajaj Finance once again. Gaurav is here with that update that the company put out. Gaurav, take it away.
Well, yes, when we look at Bajaj Finance, a strong update is what we are seeing from the company, around 23.6% growth on a year-on-year basis in terms of AUM. And at the same time, let's not forget that management had also guided the growth to be in the range of 23 to 24%. So it definitely seems that they're actually achieving this number. And in fact, they're achieving this number at the upper end of the guidance. Apart from that, when we look at the customer base now, that has increased almost by 20%. Now the total customer base stands at around 111 million. And at the same time, they have also added new customers. Around 12.2 million new customers have been added in this quarter itself, which shows 26% growth on a year-on-year basis. Let's not forget this stock is also in focus because of all the GST reforms, and given that they have a majority of their portfolio in the retail. At the same time, when we talk about Bajaj Housing Finance, there also we saw a good set of numbers, around 32% growth in disbursements. AUM grew almost by 24%. So definitely both these companies doing well. In fact, when we look at Bajaj Finance, the stock is up more than 3% given that the numbers are strong. So definitely watching out a discounter specifically because of the strong numbers. So let's see how they are also delivering their ROAs in their results going ahead.
Okay, all right. Thanks a lot for that, Gaurav. For the time being, we slip into a short break. On the other side, Manisha Gupta is waiting. She'll tell us what's going on in the commodity space.
Okay, welcome back. We've got commodities in focus as promised. Markets up about 60 odd points, much better than the opening that we got at 9:15. Manisha is here with what she's tracking and what top of mind. Manisha, good morning.
Morning, and thank you for that, Prashant. Well, I'm looking at precious metals as a whole because another day, another month, and we're looking at new all-time highs coming in for many of these commodities here. Well, I'll start with gold, and we're looking at all-time highs in the international markets, all-time highs in the Indian space as well. And with this, we have crossed $39.20 an ounce for the global markets in sense of gold there, and we are trading nearly 50% higher for this year. Now, if you look at the last couple of years, gold is almost doubled now in that sense in prices. Well, it has to be about a prolonged U.S. government shutdown, which seems to be impacting the markets right now. And then it has been about the U.S. Federal Reserve officials. Various speeches are slated starting today itself. And Thursday, you have Powell testimony as well coming in. And that is where the markets will take further direction from. If you look at the all-time highs in sense of gold, the first half of this year saw all-time highs being hit 26 times. In the month of September alone, we've seen that happen 13 times. And today, 6th of October, we've seen gold prices hit all-time highs 3 times already. So gold clearly on a run there. But it's not just about gold. Take a look at silver as well. And we are trading above $48 an ounce. 67% of gains coming in for silver as well. And markets have seen 7 consecutive gains in sense of weekly gains there. Also, silver is approaching $49.50 an ounce. This has been an all-time high. We've seen that happen twice already in 1980 and 2011, and it's happening again in 2025. Markets at this point in time is pricing in near 100% probability of a yet another U.S. rate cut for the month of October. And that really seems to be supporting gold and silver and then platinum as well, which is broken out of its 17-year consolidation. And we're looking at 12.5-year highs coming in for platinum there. And platinum clearly seems to be outperforming with nearly 82% gains in this year, with expectation that a third year of deficit in 2025 could be taking prices higher, and we could be looking at premium continuing into this space. Finally, I also want to talk about Bitcoin because we're looking at all-time highs into this one as well. $125,000 for a Bitcoin is where we are trading. 33% of gains in this year, and Bitcoin is up nearly 99% if you look at the last 12 months there. Well, clearly, it has been about the U.S. government shutdown. That has been supportive. There has been this buoyancy that we've seen in gold and Bitcoin for most of this year, with an expectation that you could be looking at an outperformance coming in from Bitcoin for the last quarter as well. If you look at the spot ETF inflows, well, they have been quite high, the second highest since ETF was launched in Jan 2024. The weakness in US dollar, all of those factors continuing to support as well. So markets are looking at further gains coming in for precious metals and cryptos.
All right, Manisha, thank you very much for that. Poonawalla FinCorp up 8%, and that's the second quarter update, which I think has been put out this morning. It's a big, sharp. AUMs are up some 68% on a year-on-year basis, and about 15.5% on a quarter-on-quarter basis. AUM at close to about just under 48,000 crores. So very fast growth coming through from Poonawalla. And I think it's kind of technically also broken out after many months of consolidation, the Poonawalla FinCorp stock. We take a quick commercial break here. We're going to come back with our special segment, Indianomics. Lata in conversation with 2 former deputy RBI governors, H.R. Khan and S.S. Mundra. And they'll be joined by Suresh Ganpati of Macquarie Capital. And we'll discuss the new banking dispensation post October 1st policy. Stay tuned. Coming up.
Welcome to Indianomics. The one sector that rallied last week in an otherwise ranged market were the banking stocks, after the Reserve Bank removed or proposed to remove a bunch of constraints and brought in more pro-market steps. The most important, according to me, banks can now fund corporates to do acquisitions. Second, the limit of 10,000 crore on total banking exposure to one group goes, that cap goes. Banks and their group companies can do overlapping businesses, which of course benefits a lot of people like HDB and, Canada Housing Finance. Risk weights, or the amount of capital that banks have to set aside for home loans and MSME loans, are likely to come down with the Basel III norms. And finally, very important, on the deposit side, premium to insured deposits won't be a flat rate. It will depend on how less or more risky a bank is perceived to be by investors. Now, to discuss how much banks and the economy will benefit, and also if the RBI has been too bold in removing some of the guardrails, I have with me two former RBI Deputy Governors, Mr. H.R. Khan and Mr. S.S. Mundra. And in a bit, we will be joined by Suresh. Okay, Suresh Ganapathy is there with us, the Managing Director and Head of Financial Services Research at Macquarie Capital. Gentlemen, good morning and thank you very much indeed for your time. Mr. Mundra, this deposit insurance marketization has not been discussed enough. Last week, we all went to town with this acquisition financing and this 10,000 crore cap. But the SBI chairman, when he spoke to us, said he spent 5,400 crore rupees in FY25 on deposit insurance, and he expects it to come down. You think this is going to be a very big benefit for, SBI, BOB, HDFC, ICICI types?
Thank you, Lata. But I think, of course, this is a no-brainer. It's going to be an advantage. Those who are running their shop well, and when you do the risk assessment and risk level is found to be low, obviously, as it is proposed, the rate of premium would be low. So, it's going to be only one way only, that whosoever is working well is going to be beneficial.
But how much, sir? How much can it benefit? Any ideas?
Pardon?
How much can the benefit be in terms of lower costs?
So it depends on ultimately what kind of slabs RBI proposed to come out with. But it could be even, I would say to begin with, it could be even 1/4 of what you are paying today.
Oh my God. Okay.
It is quite substantial. Yeah, this is how it should be. Otherwise, it has no meaning.
No,
Having said that, Lata, let me quickly, I mean to say, is a great package. There are long outstanding demands and long overdue rationalization which has happened in this. Only there are a couple of areas where I feel probably is a kind of leap of faith by RBI.
Mr. Mundra, I'll come to that in 1 minute. Let me just finish this deposit thing because it is under discussed. And I will come to where you see the leap of faith, which is a little scary. Mr. Khan, do you think the Reserve Bank has put this leap of faith even on deposits? I mean, are we not, for instance, the trouble that RBL went when Vishwa Ahuja left, or Yes Bank, or even more recently, IndusInd? Already these banks, private sector banks, they don't have the, the sovereign guarantee which public sector banks are perceived to have. And over and above that, there have been one case or the other. Do you think the RBI is being too bold with respect to small private sector banks on this deposit issue?
No, just before I talk about deposit issue, let me just quickly add one introductory sentence to what you say, slew of measures taken by RBI for the banking sector, and you said about banking sector rally. I think if you see the last few months, it has been a phase of simplification, liberalization and rationalization. Yes. And the whole concept is what is being called as optimum regulation, with bias for liberalization for the banks and ease of doing business. So this is in line with all those overarching principles. Coming to deposit insurance, I fully endorse my former colleague and friend Mundraji about this is a long-standing thing. It has happened. It's a good thing. But knowing the maturity of Indian market, one has to be a little careful about how it is communicated. If it is not communicated properly, there is a risk of run on some of the banks. So we have to properly communicate that and do bit of customer education about it. Yeah. Otherwise, but there could be some problem down the line.
It's just about 3-4 years ago, because of LVB, because of Yes, because of RBL, even unrelated banks like IndusInd suffered because people were just moving out deposits. So I'm a little worried that this flat one has gone away. Suresh, your thoughts on whether you will up the ante in terms of margins and lower operating costs for banks because of the deposit insurance. As Mr. Mundra says, it can be 1/4 of 5,400 crore for RBI, for SBI. That's a big deal. I didn't expect it to be so much. And are there more credit opportunities because of, acquisition finance?
Look, I mean, this is, if I were to really look where my analysts sat and look at the overall numbers, at an overall operating expense level as well as at the overall PAT level, I mean, even if it is a number as large as 1/4, which I doubt, but could be the case in certain entities, it doesn't move the profit parameters in a big way, Lata. I mean, right? So it is not that my earnings have to be changed about 10-15% on the back of this particular issue. There would be some 2-3% impact on earnings coming from a lower deposit cost. Just one point here that I would like to mention for the benefit of audience here is that the way the scheduled commercial banks in India have operated, never in the history, at least the time that I have tracked, a single depositor has lost money when it comes to scheduled commercial banks failing. Because at the end of the day, the RBI steps in, a forced merger takes place, and eventually the depositor gets back the entire money, right? So there is never a single rupee of deposit that is lost. It happens in cooperative banks, not in scheduled commercial banks. Okay. The premium pricing has to take that factor into account because depositors have never, ever lost money in case of scheduled commercial banks.
Okay. Yeah. No, my only fear is that the Reserve Bank has made life difficult for itself. We know that in Yes Bank's case, in several other LVB case, they went and looked for the buyer. Correct. They made life more difficult for themselves is what I thought, especially for small private sector banks. Mr. Mundra, your leap of faith, I want to come to that sentence. Where are you uncomfortable with the removal of constraints?
Yes, Lata. I was telling, of course, I said great package, over 22 measures, and some of them were really long overdue. Some of them really had become outdated. But there are a couple of areas where I feel it more like a leap of faith. Of course, RBI, I'm sure RBI must have done its best. But having said that, let me just say, one thing, it seems from the total package that a lot of faith, a lot of, belief has been put into the market mechanism and the board oversight. Now, as we all know, there is a sizable section of industry whereby, not by any, motive, but by their whole construct, by their design, and also the tenure of leadership. Both the things, board oversight as well as market discipline, may not be equally effective on them or equally applicable to them as it is on the other section of the society.
Okay.
In that situation, how much could be expected from this discipline, self-discipline to come is something I think maybe RBI will have to keep supervisory antenna very, very sharp.
Which specific rule? Which specific rule are you referring to?
Specific rule would be difficult because how do you distinguish within an industry? But probably the level of supervision, constant supervision, those are the kind of things. At least in initial years, it has to come into play. Okay. That is one area. Okay. And second area, when it comes to M&A financing, again, it was a long outstanding demand. Nothing wrong in that. It opens an avenue for the banks. I am little more worried about the aftermath of such financing. Yeah. Because if I go back to my experience with infra financing, what typically happens, let me tell you, that generally these are some of the large players who would be playing a major role in assessment and deciding the finance which is to be done.
Yeah.
Then it gets distributed among the smaller players also.
That's right.
Who normally follow the assessment done by the large
large bank.
Fine up to that point also. The point comes later on because these large players, they have two things. They have a better capability to absorb the losses if they come out of this kind of financing. Or second, which I have seen in most of the cases, I think they have seen the early signs and they have been able to exit from the exposure.
Yeah, that's
they have distribution and all that.
Yeah.
While the smaller players, they continue to hold it.
Yeah.
And it's a temptation because if you can't go and do a large scale lending and all that, and if you have liquidity and you have to beef up the balance sheet, it looks like a very, very convenient avenue.
No, that's
so great level of underwriting, but I think if it is not sharp enough, then it was an experience. We have seen it. It's not a.
I agree.
I'm little worried about it.
I agree, sir. And that's my question to Mr. Khan as well. Are we sowing the seeds for the next AQR, sir? I mean, now things are brilliant. Low leverage, banks, very low credit cost, ultra low. We haven't seen those numbers in our lifetime. I'm sure you will know your memories stretch back. But, if you get into, at this point, over 10,000, okay, that 10,000 crore I thought could have become 20,000 crore or 25,000 crore. Do you want to remove the cap altogether? Are we inviting trouble? And also, that little bit of a leg up we thought bond markets are getting, that also goes. So are you happy with this 10,000 crore cap going?
Oh, Lata, I have a vested interest here. I was part of the committee which had recommended that part of the borrowings by the large corporates, they have to move to corporate debt market because the whole idea is that the banks are getting overexposed and they are not really, they will have asset liability mismatch, they will have a skill gap. So let it be market mechanism to a certain point. That was the whole idea. And it has run for a while, but there has not been really any assessment. Actually, it was brought down from 25,000 to 15,000 and 10,000. As you said, possibly we could have increased the threshold and seen how it is working. So that is one area one has to look at, because the rationale given is that individual bank level, there is a group exposure limit. So we need not so much worried about the system level exposure. But there could be some risk lying there. So one has to be very, very watchful. On the merger and acquisition finance, I think this is their demand for a quite long time. In fact, you should know that it is not totally no. In fact, there is some element of merger and acquisition finance exists now. For example, if you want to invest overseas, buy a company overseas, there is a finance available from the bank. And if there is a joint venture partner in infra project to buy out his share also, acquisition finance is available. But what is being done is a broad sweep. But let us wait for the draft guidelines. I hope they will maintain certain minimum level of equity from the promoter, because let there be no gold plating happening. But on the point of, just quickly on the point of what my friend Mr. Mundra said on board oversight and supervisory antenna, I think they are very, very important points. And if you are giving so much of relaxations in the board and corporate governance standards.
Mr. Khan, I'll come back with those details. We have to run into a commercial break. One word from you, Suresh Ganapathy. Do you think credit growth is going to sizably improve because acquisition finance has come in? I mean, banks don't know whom to lend to. There aren't even any takers. Will this open an avenue sooner rather than later?
Look, these things are good supply-side reforms in the longer run. In the near term, there is a significant demand issue, right? For example, a lot of these acquisition financing, Lata, in the private credit markets, if you look at it, happens at an IRR of 15, 16, 17%. Now, that's a portfolio that banks won't take necessarily, right? So you are looking at a reasonable chunk of acquisition credit which banks won't finance because it will not fit their risk appetite. So you have to look in that context. So while I'm not specifically put a particular number to this particular M&A related thing, but maybe perhaps a percentage point here or there could be an improvement in credit growth, but not more than that. Longer term, obviously, corporates are flush with liquidity, there is excess equity, capital markets are buoyant. So, and even ECB rules, for all that ECB rules have been relaxed. So why not? Corporates can move towards ECBs rather than relying on some of these markets.
Only it is coming at a time when the currency is on a slippery slope. But I guess once it stabilizes, that is going to be a very big source of financing. Quick break. We have lots more questions for our guests. Bazaar viewers, you will be watching Chartbusters. You'll get to watch the entire argument and show after market hours.